this is Olaiboy of Commercial Property Club, our podcast. Welcome to another episode of our Commercial Property Club podcast, chapter 41. Actually, that's what we're going through today, and today we'll be diving into a very interesting topic. Today we're going to be looking at 2026 update capital market trends for multifamily assets, quarter one, and the new norm. That's what we're going to be looking at. We're going to be seeing how things are shaping out for the apartment sector. Today we'll be talking about certain things that we ought to be looking at this for first quarter. I will see you when the show starts. Thank you for joining me once again. This is your favorite show, Commercial Property Club podcast. I'm your host, Olaiboy. We're officially 3 months into 2026, and we want to summarize what the capital market is looking like. The sentiment is word here is we're looking at an equilibrium. For the past few years, we've dealt with great disconnections where sellers were anchored to 2021 pricing and buyers were handcuffed by 2024 rates. But as we sit right here in the fourth quarter of 2026, the tide, or rather the fog, is clearing out. Today we're going to discuss the current state of the capital stacks that we have out there, why it's finally being deployed out there, and the specific loan products that we are winning for today for value-add apartment investors like us. Whether you're looking to refinance or run your next acquisition, today's show is your roadmap to your lending facilities. So just stay tuned. So we're looking at the macro view of things in terms of the rates, in terms of the realities of things. Let's talk about the elephant in the room, the interest rate. As for quarter one 2026, we look at what the Federal Reserve has successfully navigated, the soft landing. We're not seeing the zero rate environment of the past, but we have found a rather predictable baseline that we're over in right now. The 10-year Treasury, we see stability in between the 3.5% to 3.8% range. This stability is more important than the actual number. It's allowed lenders to price risk accurately again. We see cap rate stabilization. We're seeing a significant narrowing of the bidder asking gaps. So in major markets like Dallas, Fort Worth, Phoenix, Atlanta, cap rate for your B-class apartment assets, value-add assets, have settled between the comfortable rates of 5.5% to 5.9%. So let's see what are the sentiments that we might want to look at. We'll wait and see the approaches. Maybe institutional and private capital groups realize that sitting on cash is now more expensive than entering than before. So it's now time for them to enter the market at this stable level. Now let's look at the lending landscape. Who's writing the checks right now? So where's the depth coming from in 2026? It's a very kind of like a different mix than what we saw the last 2 years. The return of agency debt, we're talking about the likes of Fannie Mae and Freddie Mac, are back in big ways for this first quarter. They are prioritizing affordability actually and mission-driven deals. If your value-add play keeps rent at attainable level for the workforce. The agencies are quite offering very attractive leverages. They're giving up to about 60 to 70% LTV with competitive incentives to go with that. Let's look at the regional banks versus the debt funds. Regional banks are still a little bit, cautious with their balance sheet. But debt funds have stepped into the void for bridge lending. As we see, if you have a heavy lifting value add project, debt funds are offering bridge to permanent loan products that are much more flexible than they were in the year 2024, maybe often with 3-year terms and to 1-year extensions in some cases, actually. Let's look at the preferred equity. This is the bridge of 2026 because senior lenders are capping loan to values more restrictly right now. We are seeing a massive surge in the preferred equity to fill that 10 to 15% gap in the capital stack. It's more expensive than your senior debt, but it's cheaper than bringing in more equity and diluting your returns at the back end, actually. So what's the strategy? Winning the capital stack. What would be the strategy? How do you position yourself to for deals to get funded today? Lenders in 2036 are just looking at the asset. They're looking at not just looking at asset, but they're looking at also your operational data. We're talking about expense ratios. They're looking at your expense ratios, actually, and they look at things also in this scheme of things of insurance and taxes, looking at your overall pro forma, if you have accounted for also for your 2025 insurance premiums, your deals will get rejected. That's if you've not accounted for that. You need to also show a clear path to operating expenses, also to reduction through technology, things we've talked about in the past, like the AI-driven analysis and smart utility management scheme of things. So we see like interest rate caps, while the cost of caps has come down significantly from 2023 peaks. Lenders are still requiring them to. They're requiring something like for any floating rate debt. So my advice would be look at a fixed rate 5-year term debt for mostly your value add place, actually. Then the spread is currently more favorable than your floating rate debt bridge loans once you factor in the cap costs. So what are my predictions for 2026 before I wrap up my show for today? Well, I would say watch out for smaller syndications for firms that are merging with large institutional platforms. The cost of compliance and capital raising is favorable right now. So the rise of retail capital, let's talk about that also too. We are seeing more individual investors move away from the volatility of the stock market and backing into the private real estate fundings, specifically income funds that prioritize cash flow over 5-year appreciation. Also to distress is a target. The wave of distress that was predicted in 2025 didn't hit like a tsunami as it was predicted. It has some series of pockets of it here and there. Smart capital is picking up stalled 2021 vintage deals that just needs recapitalizations and a fresh management team in place. So that's my predictions for 2026. I would see you in another episode as far as a deep dive into the Q1 2026 capital market. The window for generational entry into multifamily is wild. I would also say there's an opening right now because the volatility has subsided, and the competition hasn't fully returned to the levels of 2021. Actually, if you have a deal you're looking to capitalize on, or if you're an investor looking to place equity in current market, reach out to us at Commercial Property Club. You can send me an email at ola.i@commercialpropertyclub.net. You can link up with us on our channel on YouTube. Subscribe. You can also link up with me on LinkedIn, Facebook, Instagram, and let's talk. Thank you for tuning in for today's episode. Keep adding value. I'll see you in my next episode here at Commercial Property Club podcast. Have a super good day. So